Okay, learning objective 7.3. We're going to explain how to account for the depreciation on planned assets. So let's make sure we're clear on terminology. We use the term book value. And the term book value means planned assets are recorded on the balance sheet at their book value. What is the book value? Well, the book value will be equal to the cost minus any related accumulated depreciation. When we talk about the word depreciation, I mentioned it to you earlier. Again, the references, your exposure might have been that when you're buying a car, you drive off the lot, loses value. That's depreciation in your mind. It's all related to fair market value. And although this is pretty similar in terms of the ending results of how it's all going to end up working, of how it all works out anyway, that's not quite the objective here for accountants. Depreciation is the process of allocating a plant's assets cost to expense over its life. So that's very clear. It's the allocation of cost, the plant cost, over the useful life of an asset. It's necessary as plant assets wear out, grow obsolete, and lose value over time. Now, it does tell you that there's value being lost here, but again, that's not quite the objective of depreciation. Even though it's something that really kind of grows consistent with what we're doing, that's not the objective. The first bullet point is the objective. It allocates costs against revenue. It helps earn each period. I mentioned that to you earlier. An asset that's purchased in 1 year may help us generate revenues for up to 5, 10, 15, 20 years. So it wouldn't make sense that we write off the original cost of that asset all in 1 year when we know it's going to help us generate income for several years. So the process of depreciation allocates costs against revenue that it helps earn each period. Depreciation expenses are reported on the income statement. And here's also something I mentioned to you before. Land is not depreciated. As an example here, you have a Boeing 737. This is an asset that will likely last up to 20 years. Now, these are very expensive planes. I'm sure they cost quite a bit of money. It looks like maybe in this example here that the original cost was $32 million. So this piece of equipment, this airplane cost, it does say it costs $32 million. Well, that $32 million is going to be divided in this example here. We'll actually see that there are some different ways of doing this, but let's make it simple first. 32 million divided by 20, that's the 20 years we think it's going to last. That means every year we want to recognize 1.6 million of depreciation. Well, if that asset is going to help us generate 9 million every year for as long as it exists, then we're not going to write off the 32 million in 1 year. We're going to break it out over 20 years. And so every time we recognize $9 million of income, of revenues, we're going to go ahead and recognize 1.6 million of expenses associated with the cost of the asset. That's consistent with the matching principle. If you recall, the matching principle states we must match expenses with corresponding revenues. Again, like I mentioned, we write off that 32 million in 1 year and it's still generating revenues for us for 20 years. That makes no sense if you want to be consistent with the matching principle. So the $32 million is going to be divided over 20 years, and the company will recognize $1.6 million per year of expenses to be matched against the annual revenues of $9 million per year. Some additional terms we need to really understand: how to measure depreciation, the cost. Well, we've talked about the cost, the purchase price, and all costs to get plant asset ready for use. It is a known amount. Okay, so the cost, in the previous slides, we talked about what gets added to the cost. So don't get confused. It's all the costs necessary to place the assets, to get the asset ready for its intended use. So we're good with the costs. We also need to come up with an estimated useful life. Now, we don't know for sure how long an asset's going to last because we're doing a little bit of guessing here. But for the most part, we can come up with a reasonable guess, and that would be the length of service expected from using the asset, and it is an estimated amount of time. And then the residual value is something else we have to take into consideration. It's estimated. It's how much we expect to get in cash when we sell the asset after we're done with it. So the cost is known, the estimated useful life is an estimate, and the estimated residual value is obviously an estimate. There are three main depreciation methods that are used. You'd likely would find that most companies use these three, particularly for financial accounting purposes. These three methods, straight line is probably the most commonly used, followed by the double declining balance, and then maybe units of production. So here's what we're also going to be needing in order to compute what the depreciation should be. The objective is going to be, what is the annual depreciation? We're going to be booking depreciation every year. What is the annual depreciation? So in order for us to do that, we're going to first start off with the cost. And since I guess we're going to be using a truck, we'll take the cost of a truck. So let's assume that we purchased $41,000. We purchased a truck for $41,000. We estimate that at the end, when we're done using this truck, it looks like I'm going to cheat here. I'm going to go to it. It looks like in 5 years, we estimate that we'll be able to sell that truck in 5 years for $1,000. So we're going to actually subtract that from the cost of the truck. And that gives us what is referred to as the depreciable cost. We're going to depreciate $40,000. We're not going to depreciate the $1,000 because that's what we think we're going to sell it for in 5 years. We're going to depreciate $40,000. Now, to add to that, the estimated useful life is 5 years, something we kind of cheated on figuring that out earlier. And the units of production is 100,000 units. Or in this case, because it's a truck, it's going to be miles. So 100,000 miles. So we think this truck is going to last us for 5 years, and we'll be using about 20,000 miles per year. So the total amount of miles we're going to be using is 100,000 miles. Okay, so let's go to the first. Remember, there were 3 different depreciation methods. Let's go to the first one. The first one is the straight line method. Now, the straight line method is the one that's most commonly used, probably because it's easiest, and nobody can really argue the straight line method is whether it's, it's just tough to argue whether it's right or wrong. We're just simply taking depreciable costs divided by the useful life to determine the annual depreciation expense. So let's take a look. So let's say we have the cost of the truck is $41,000. The estimated residual value is $1,000. Therefore, we can compute the depreciable cost by taking the cost less the estimated residual value, and that depreciable cost is $40,000. Under the straight line method, we're going to take the depreciable cost and we're going to subtract the residual value, and then that's going to be divided by the estimated useful life. In this example here, the estimated useful life is 5 years. That's what they told us here. Estimated useful life, 5 years. So let's use 5 years. So therefore, our annual depreciation is going to be the 40,000 divided by the 5, $8,000. Every year, we're going to book a journal entry and recognize $8,000 of depreciation. So the way that journal entry is going to work, we're going to debit depreciation expense for $8,000. We're going to credit accumulated depreciation, $8,000. Debit, credit. And that's going to be the annual entry for 5 years. The slide showed the computation of $8,000, and then the slide shows the journal entry. Now, the next thing we're going to do is we're actually going to form a depreciation schedule. If we purchase this on 1/1/2015, the original cost was $41,000. Now the rate is going to be, well, we don't have a rate. For the original, that's just the recording of the original costs on 1/1/2015. There's no depreciation that we're going to be recording. We're simply just setting up the book value. So we're going to take the cost minus the accumulated depreciation, which in this case, there is no depreciation that's been accumulated so far. It's the first day of the purchase. So on our books, we're going to see $41,000 listed for the truck. $41,000 cost. On 12/31/15, that's going to be at the end of the fiscal year. We're going to come up with a depreciation rate. And in this case, it's going to be 0.2. Now, how do we come up with 0.2? So the depreciation rate, we're going to take the depreciation rate is going to be 1 of 5 years or 1/5, which equals 1/5 equals 20% or 0.2. Now we're going to show that on the schedule using a rate because that's going to be relevant when we're actually using the other depreciation methods. We already figured that the depreciable cost is going to be $40,000. That's the 41 minus the 1. The 1 is the residual value. And the yearly expense, we could compute this. We've actually already figured this out, but we could compute it as 0.2 multiplied by 40,000, which gives us 8,000. So in the first year, this 2015, our accumulated depreciation is 8,000. And now the book value, which we remember is the cost minus the accumulated depreciation, is $33,000. So now we go to the next year. The next year is going to be 2016. The rate is going to be the same. We have the same rate every year. The depreciable cost will be the same. The yearly expense is going to be the same. But the accumulated depreciation is going to be what we had done in the past, the 8,000 we had done already, plus the new depreciation for 16. And now the book value is going to be $17,000. And now the book value is going to be $25,000. So we have the 0.2 that comes down every year. That doesn't change. The depreciable cost every year is the same. It doesn't change. We have the $8,000 per year doesn't change. The accumulated depreciation will change every year because we're adding another $8,000 every year. First year was 8,000, then it's 16, then it's 24, then it's 32, then it's 40. The book value, because the accumulated depreciation changes, so does the book value. So now by the end of year 3 in 2017, we're at 17,000. And then at year 4, which is 18, it's at 9,000. And then finally, in the last year, we depreciated it so that the final book value is at $1,000, which is equal to the residual value. Here's the same schedule listed on the slides. That covers the straight line depreciation. The next depreciation method is referred to as units of production. The units of production method is intuitively probably what makes most sense, but it's not as easy, and so therefore you're not going to, it's not as widely used as a straight line. So units of production is going to be a fixed amount of depreciation is assigned to each unit of output produced by the asset. Depreciable cost is divided by the useful life in units of production to determine the fixed amount per unit. And then the per unit amount is then multiplied by the number of units produced each period to compute the depreciation expense. So let's go back to our schedule. And in this schedule that we use to compute what the annual depreciation, in the straight line method, we used the useful life. So for units of production, it's going to be pretty similar. We're going to take the cost minus the residual value, and then we're going to divide that by the useful life but this is going to be in units of production. Now, if we go back to that slide, way back in the day, that slide showed that the estimated useful life in years was 5 years, and that's what we used for the straight line. But for the units of production, it was 100,000 miles. Okay, so 100,000 miles. So we're going to take the cost minus the residual value, which we've already done. That's the depreciable cost of 40,000. And we're going to divide that by 100,000. And that's the units. In this case, it's going to be miles, right? We think that this is going to last us 100,000 miles. So what we're really figuring out is what's the cost per mile. In terms of dollars, our rate is going to be 40 cents per mile. So we're good to go. We have what we need now to complete a depreciation schedule for units of production. Okay, so we have a new depreciation schedule. This one is going to be used for the units of production. The cost is going to be the same. The book value is going to be the same after our purchase. The question becomes is what's our first year's depreciation? Well, we're going to first go ahead and fill out what we're going to need for the entire period or for all 5 years. We have the information we need now. This is going to have to be provided. It's 20,000. Says the FedEx expects to drive the truck 20,000 miles during the first year. So let's put first year is 20,000 miles. 30,000 miles during the second. 25,000 miles during the third year. 15,000 for the third year or fourth year, and then 10,000 for the fifth year. So all that was provided in the narrative that it was 20, 30, 25, 15, and 10. Now the rate, we computed it to be in the slide back here. Where was it here? Yeah, this is where it was at. Let's go ahead. Here we figured out that the units production rate is 0.4 per mile. So we can drop that in, 0.4. I guess we can designate that as dollars. So then the annual expense, yearly expense, is going to be simply the rate multiplied by the miles. And you could say now every year is fluctuating based upon the number of miles that was used for that period. So the accumulated depreciation is going to be 8,000 in the first year. We'll take the first year and add the second year depreciation to come up with our accumulated depreciation after 2 years, and then we can fill that in all the way down. So by the end of the fifth year, we will have $40,000 depreciated using these numbers. The book value is going to be the original cost minus the yearly expense. We're at 33,000. We're down to 21,000, then 11, and 5, then 1. So this is what our depreciation schedule will look like using units of production. And if we go to the slides, you might have already seen it. It looks just like what I put together. The third method is referred to as double declining. The double declining method writes off a larger amount of costs near the start of the asset's useful life. For some people, that makes most sense because one could argue that most assets produce more revenue when they are young, in the first few years. And as they age, they become less productive. Kind of like human beings, huh? Oh my goodness. So what the argument is, if we're going to be matching revenues with corresponding expenses, we need to write off more of an expense in the early years. This is the most frequently used accelerated depreciation method it's commonly used for, or a similar depreciation method is used for tax purposes. And what you're doing is you're multiplying the asset's declining book value at the beginning of the year by a constant percentage. It is 2 times the straight line depreciation rate. So this is going to be why we ended up coming up with that rate when we're using the straight line, even though we really didn't need it. Okay, so let's take a look at that straight line rate. If you remember the straight line, what we used was 0.2. We didn't need it because we already computed what the annual depreciation was going to be. We computed it to be 8,000. But technically, every year we were going to write off 0.2. Why 0.2? Because it is one. Well, first of all, the useful life was 5 years. So if you're trying to figure out, well, how much you're going to write off per year, it's 1/5. If you think about it, if it's going to be, if your useful life is 3 years, then every year you're going to be writing off 1/3. If your useful life is 6 years, you're going to be writing off every year 1/6. Well, in this case, since we're going with 5, we figured that we were going to be writing it off over 5 years. That means 1/5 is written off every year. 1 divided by 5 is equal to 0.2. 0.2 is 20%. So the DDB rate will be equal to 2 times the straight line rate. Well, we already figured out what the straight line rate it was 0.2, right? So the straight line rate, 0.2, we're going to multiply that by 2 because it's double. So the DDB rate is 0.2 times 2, which is 0.4, or 40%. So to review, the reason why we got 0.2 was during the straight line rate, we were depreciating this asset for 5 years. That means every year we're writing off 1/5. If we're writing off 1/5, that becomes 20% per year. If we're doubling that, that is 40%. So double declining balance is double the straight line rate. The slide shows how to compute it. DDB depreciation rate equals to 1 divided by the useful life, which this ends up being the 0.2 times 2. 1 divided by 5 is 0.2 times 2. 20% times 2 is 40%. Okay, so let's see how this works. We have our rate, our date, our cost. We'll have the DDB rate. So the cost is the same. The book value at the end of the, right when we purchase it is the same. That there's no difference between this process so far as it then when compared to units of production or straight line. But the difference is going to be now when we actually compute using DDB, using double declining balance. When we actually compute the yearly expense, we go ahead and use the book value. So in other words, $41,000, the total book value is going to be multiplied by 0.4. So the annual depreciation, or the first year's depreciation, will be $16,400. And that's going to be my accumulated depreciation. The book value is going to be the 41,000 less the yearly expense, which is 24,000. So book value minus the yearly expense is 24,000. So now our new book value is 24,600. Again, a little bit different now. We're going to take the double declining rate and multiply it by the prior year book value. So 0.4 multiplied by 24,600 gives us $9,840. And then this becomes very similar. We're going to take accumulated depreciation from the prior year, add 9,840, so that gives us 26,240. And then our book value is reduced again. And this happens for the next 2 years. And I say the next 2 years because we've got to check out the last year is going to be a little bit of a quirk, right? So after the 4th year, we're at $5,314. Now, if you recall, the residual value equals $1,000. We don't lose sight of that. We still need to write off our asset until it hits the residual value. We didn't use it up here under the DDB. We didn't use it here. We haven't used it in terms of taking into consideration anything here. But we do want to make sure that the book value is going to be equal to $1,000. So in other words, I'm just going to plug this in. It has to be, that's what we want it to be. So what does that mean? That means that our yearly expense for this year is not going to necessarily be computed, it's going to be plugged. The difference between $5,314 and $1,000 is $4,314. We'll put a little star here so that we know how we computed that. That's our reference. How do we do that? So the way we made that work, we plugged it in, we said it was $5,314 minus the $1,000 we wanted, and that then equaled 4,314. And that's ultimately what we wanted, because we're going to take this book value, subtracting this yearly depreciation for 2019, and that gives us a book value of 1,000. Now we are done depreciating. So the PowerPoint will show very similar what we just drew up. The DDB method differs from others in 2 ways. You have the residual value is ignored initially. That first depreciation year, we're going right to the book value, so we're not taking into consideration the residual value. So we ignore it there. But to make it all work at the end, the final year depreciation has to be a plug. So we can compare the 3 depreciation methods using the straight line, the units of production, and the double declining balance. The straight line, according to the text, the straight line is best for planned assets that generate revenue evenly over time. Units of production is best for assets that wear out because of use. And double declining balance is best for assets that generate more revenue earlier in their useful life. And I'm not going to redraw this. This is pretty straightforward, but if we were to actually compare all of the depreciation expenses, or each year's depreciation expense, and just line them up next to one another so that we could see the differences between straight line, units of production, and DDB, you could see that the straight line is even throughout the entire life of the asset, 8,000 per year. Units of production will fluctuate based upon the actual units used. In this case, because it was a vehicle, it was miles, but it could be, you might be asking, well, what do you use for a machine? Well, a machine would be maybe hours. The number of hours a machine is, you estimate the number of hours for its useful life, and that becomes the unit of production of measure. So every time you keep measuring the number of hours, and that's going to help you generate your depreciation per year. And then finally, it's the accelerated depreciation of DDB, double declining balance. And you can compare them across. See, it didn't look like there was much difference between straight line and units of production, but then it went up for units of production, stayed steady for straight line like it should. And then slowly you could see it started to wear down. A double declining balance just simply took much more in the first year, and each year began to slow down. If we were to draw a graphical representation, and oh my goodness, that's why they call it straight line, because if we were to graph it out, the dollar amount that you're depreciating per year on the y-axis, and then on the x-axis is time. So the dollar amount, because it's over time, is going to be the same every year. You have a straight line. which is why they refer to it as straight line depreciation. Oh my goodness. Units of production, you'll see this kind of a fluctuation. Goes up, then down, but it's all based upon the units. And then the accelerated depreciation shows how you're writing off much more in the early years, and then over the life of the asset, you write off less. When we look at the next slide, we could see that the depreciation methods used by a sampling of 600 companies, 88% of them use straight line, 7% used an accelerated method, not necessarily DDB because there are other accelerated methods, but that's an example. 4% used units of production, and then you can use even one that you make up yourself as long as you're ready to argue in court that it works. But there are companies that do. Probably an industry standard situation. Other issues in accounting for plan assets. Plan assets can be complex because they have long lives. The depreciation affects income taxes. Because depreciation is an expense, depreciation expense, it lowers net income. If it lowers net income, then you pay less in taxes. Companies may have gains or losses when they sell the plan assets. Most companies use straight line depreciation for financial reporting purposes, but something close to what's referred to as double declining balance for tax purposes. And the reason being is that companies would prefer to pay less taxes today. The time value of money suggests that if we can save some taxes today, then we're better off. And so that's why they'll use accelerated methods. The textbook discusses how accelerated depreciation provides fastest tax deductions. Tax deductions reduce income taxes. Reducing income taxes help conserve cash. So here's a schedule that actually shows the impact of an accelerated method in terms of income taxes. Let's say they have cash revenue of $400,000 between the two. You have operating expenses between these two are the same. Net cash provided by operating before income taxes is $8,000. When we take into consideration depreciation expense, that's $8,000 for straight line and $16,400, and this is for the first year only. Okay, this is just the first year. Remember that because this changes every year. For straight line, it remains the same, but this changes every year. Well, this is just the first year. $16,400 in the first year. So in that first year, their income tax is $92,000 using straight line, and only $83,600 for using the accelerated method. If you use 30% as a basis for computing your income tax expense, under the straight line, it's $27,600. Under the accelerated method, it's only $25,080. So by using the accelerated method in the first year, you are conserving $2,520. The difference between the income tax amounts. Intuitively, you might be able to recognize or might argue, well, yeah, that works in the first years, but in the later years, I'm going to be paying more taxes because I'm writing off less. And that is true. You don't, over the life of the asset, you don't write off more than what you have. If you paid $41,000 and you have a $1,000 residual value, then you're going to write off $40,000 over the life of the asset, no matter which method you use. So you're not generating or making up costs. You're going to end up paying for taxes in the future because you don't have the expenses in the future. You're using them all up in the first years. However, the time value of money says that this is still a good strategy because you'd rather save that dollar today so that you can earn interest and income over the next 2 to 3 years on that dollar. And therefore, you'll have more money by the end of the life of the asset. Tax uses what's referred to as Modified Accelerated Cost Recovery System, which is MAKERS. This is very close to DDB, but you can see there's it's by statute. The amount of life that an asset has is dictated by tax code. So assets that have a 3-year life, the example would be racehorses. Imagine that when you buy a racehorse, you depreciate that racehorse. You can use the DDB, it'll be over 3 years. Automobiles, light trucks, and computers can be written off over 5 years. Office furniture, 7 years. Most other equipment, 10. Sewage treatment plants are written off over 15 years, but they don't use DDB, they use 150% DB, which is almost DDB. It's almost double, but it's 1.5 times, right? Not 2 times, 1.5 times. For residential rental property with 27.5 years, and for non-residential or commercial property, it's written off over 39 years. So let's talk about depreciation for partial years. In this example here, suppose FedEx purchases a warehouse building on September 1, and they pay $500,000. The building's estimated useful life is 20 years, and its estimated residual value is $80,000. FedEx's accounting year ends on May 31st, so they bought it midstream. They bought it in the middle of the year. Now, if you recall, a full year's depreciation is going to be computed using the straight line method. They don't even mention it here, but that's what we're going to be looking at. A full year depreciation would be the 500, the cost, minus the residual value, which is 80,000, 500,000 minus the 80,000 divided by its useful life, 20 years. 500,000 minus 80,000 divided by 20 gives us 21,000. So under normal circumstances, for the full year, we're going to write off $21,000. However, because they purchased this asset during the year, in fact, in most cases, assets aren't conveniently bought on the first day of the fiscal year. So what we're going to be looking at in the first year, we're going to be doing a partial depreciation for that first year. It appears we purchased it on September 1. So that means all of September, October, November, December, January, February, March, April, and May. So there's 9 months that are in play for this fiscal year until they have to report or prepare their financial statements. So not the full 12 months for a full year, but definitely 9 months. Therefore, we're going to take 21,000, the annual depreciation, and we're going to multiply it by 9/12. 9/12 says 9 out of 12 months for the year. So in their first year of depreciation, they're going to write off 21,000 times 9/12, which is equal to $15,750. Now you might be wondering, well, what happens if an asset is going to either last longer than we anticipated or is lasting less than what we anticipated? So the next slide refers to changing the useful life of a depreciable asset. It goes on to explain that after an asset is in use, managers may change its useful life based on experience or new information. And when this occurs, we refer to it as a change in accounting estimate. Now, it's important that we understand what this is. This is a change in accounting estimate. And what that means is what's happened in the past has already happened. There's nothing we're going to do about it. So what we're going to do is we're going to take the information we have as of today, make an adjustment in terms of our estimate, and go on. We're not going to worry about prior years or what happened in the past. So the example here is, let's assume a Disney hot dog stand costs $50,000 and originally had a useful life of 10 years with no residual value. Disney used the asset for 4 years, resulting in an accumulated depreciation of $20,000. Well, let's see if that makes sense. $50,000 cost, no residual value, so we're going to go ahead and depreciate that over 10 years. So 50,000 divided by 10, that means every year we're going to write it off. We're going to write off $5,000. 5,000 times 4 years, 5,000 4 years will give us $20,000. So that makes sense. $20,000 of accumulated depreciation with the remaining book value of $30,000. Well, 50,000 less the accumulated depreciation of 20 gives us 30,000. So we're into it 4 years, and now we think it's going to last us a little longer. So management now believes the assets will remain in use for an additional 10 years. So in total, it's 14 years, but really that's not relevant. We know that we had 6 years to go, and now we're saying, no, it's not going to be 6 years, it's going to be 10. But what do we know? We know that our remaining book value is $30,000. There's no residual value. So what we're going to do is we're going to take that 30,000 and we're going to divide it by the 10 years. The past is the past. We're only worried about the future. It was an estimate to begin with. So 30,000 divided by 10 means now we're going to write off 3,000 per year. 30,000 divided by 10. So from here on out, the past is the past. We're not worried about what happened over the last 4 years. We're simply going to, from here on out, we're going to write off $3,000 per year, depreciation expense 3,000, accumulated depreciation 3,000 per year for the remaining 10 years. We have the term referred to, or the terms that refer to fully depreciated assets. A fully depreciated asset is an asset that has reached the end of its estimated useful life. So in other words, we expected an asset to last for us for 5 years, and now we're 5 years into it. It's fully depreciated because it's all based upon the numbers we came up with. Now, just because the asset is fully depreciated doesn't mean that we stop using it. We're going to continue to use it until it's no longer usable. It's just going to remain on the books as fully depreciated, and we won't go back and make any adjustments. It's already been fully depreciated. When we have disposed of the asset, when we get rid of it or we sell it, then that's when we're going to remove it. But in the meantime, I mean, there are plenty of companies who have assets that have been fully depreciated that just, they keep using because they end up lasting longer than what was anticipated. So if we have the example here, we're going to see that we purchased equipment for $60,000. And over the useful life, we've already written off $60,000. That's the credit towards accumulated depreciation. So the book value is the cost minus the accumulated depreciation, and that gives us a book value of 0. It does not matter that it's still working, that we're still using it. We just have an asset with a 0 book value, and we don't worry about it until we either sell it or dispose of it.